Well, good morning, investor and corporate. Welcome to SET Digital Roadshow third quarter 20 and 21 performance review. This section will run about 45 minutes, including Q&A. Company will start the section by 30 minutes presentation, followed by 15-minute Q&A. And during Q&A, investor may leave your question in meeting room chat box or use raise your hand function. We will open your microphone so you can ask the question to the company directly. So may I now invite Thai Oil Public Company Limited to start the presentation, please. Thank you very much.
Good morning, everyone. My name is Vanida Bunchalat, the CFO of the Thai Oil. Let me start the presentation. First of all, we will get to the key highlight first, what happened in the Q3 of this year. Basically, we're going to start with the definitely for the COVID-19, the pandemic situation. We can see that from the widespread of the vaccination across all over the region, and together with the easing travel restriction, this also pushing up the demand for the petroleum product improve in Q3. As we can see that from the gasoline of demand, the mobility index, which is the index that we can see the improvement of the gasoline demand approaching nearly the pre-COVID level already in Q3. And also for the demand from the jet, also improving from the more the flight activity that it's been gradually increasing in Q3 from the reopening all in many countries in the Q3. For the next one would be like the tailwind from the energy crisis that recently increasing in the EU and also in China, drive the gas price skyrocket. This also a potential for the gas to oil switching, and the benefit to the margin in this Q3. This come from the crude oil price increasing quite a lot. It will be like the record high compared to the past. And as we can see that the GIM in Q3 represented by the Singapore GIM in Q4 until today is around $7.5 per barrel. Which we haven't seen this number for quite some time ago, and we can see that the almost of the crack spread of the product in the Q3 and also for the Q4 until today improving quite a lot comparing Q on Q. This is basically from the improving of the situation of the COVID-19 and also the pushing of the demand of the petroleum. And continue. The highlight that I would like to address in the Q3 that as the crude oil price increasing in the Q3, so Thai Oil we realized the more stock gain in this quarter, and also from as I mentioned that from the situation of the COVID-19 that improving, so the demand from the domestic sale in Thailand also get improved as well, and the GIM as I mentioned it getting better comparing to the Q2, and demand from the aromatic side and also from the LAB also in a good shape in Q3. So to summarize in the next page for the performance in the Q3, we can summarize as this. Starting from the crude price in Q3 is improving around $1 per barrel, closing at the $72.6. And for the 9 months, the Dubai increased quite a lot, around $30 per barrel, closing at the 72.6. This are basically from the demand that get improved from the situation of the COVID-19 as I mentioned, and from the also the factor from the supply disruption from the Hurricane Ida and the shortage of the energy crisis in EU and China as I mentioned. This also pushing the Dubai price quite a lot in Q3. So we continue with the margin of the refinery and the GRM. We can see that the market GRM in Q3 improved Q on Q from 0.4 in Q2 to $1.6 per barrel in Q3. Basically, it's come from the spread of the almost of the all the product for the gasoline and for the middle distillate and also the fuel oil spread. Basically from the demand and some shortage of the supply disruption. And we combine with the stock gain in Q3 that we realized from the higher from the crude stock at the 5.1 stock gain. So accounted in, we will get the accounting GIM from the refinery in the dark blue color below at the 6.7 in Q3, and for 9 months is almost the same at the $6.3 per barrel. And going to another BU of the Thai oil to the downstream for the aromatics and the LAB. I think in terms of the spread of the aromatics in Q3, slightly higher Q on Q, following the crude oil price from the activity of the more recover economics. Comparing to the spread of the benzene, soften a bit Q on Q. I think what is come from the slower demand from the downstream sector, basically from the power rationing in China. So in terms of the GIM contribution to the Thai oil, the margin of the aromatics and the LAB BU in the gray color in Q3 is a contribute at the $2.1 per barrel in Q2, soften a bit Q on Q as I mentioned. And going to the next BU for the lube base, in Q3, the lube base oil in Q3 lower than Q2, which is exceptional high, mainly from the more supply that come in Q3 from the increasing the refinery back to run. So that's why we can see that the GIM contribution from the base oil in Q3 it's around $1.8 per barrel comparing to a 2.4 in Q2. So if we combine the margin from the 3 BU refinery, aromatics, LDB, and also for the lube base, the GIM, the gross integrated margin, it will combine to the market GM at the 5.5 and the combine with the stock gain at the $5. So we have an accounting GIM and in Q2 at the $10.5 per barrel, and for 9 months almost the same at the $10.2 per barrel. And to the next one, right? The next one is be like to in the breakdown a bit. Let me summarize, and I think we have a more detail in the performance section later on that will be presented by Khun Chosak. So in Q3, the performance, our bottom line, Thai oil, we have a net profit in Q3 at the net gain of the 2 billion Thai baht, or equivalent to the earning per share around 2.6 baht per share. In terms, if we look at the net operating profit in the dark blue color, in Q3, we realized at the 1.2 billion Thai baht, comparing to a 1.3 in Q2, slightly lower. I think this is basically from the lower utilization rate in Q3, and also from the lower contribution from some subsidiary, especially from the GPSC, the power company in Q3. And also in the light blue color in Q3, we also realized a stock gain at the 3.9 billion Thai baht, equivalent to a $5.1 per barrel from the crude oil price increase, as I mentioned in the slide before. And for the other items in gray color in Q3, we can see that we have have the loss at the around 2.8 billion Thai baht. This come from two factors. The first one in Q3, we have the loss in the commodity and hedging, which comprise it into two main items. The first one is that for the commodity hedging in Q3, we have the realized loss around 479 million Thai baht, which basically mainly from the IFAC crude hedging. And this shall be offset with the stock gain at 3.9 billion Thai baht in the light blue color. So the net position that we still gain from the hedging commodity. And the other part would be the unrealized loss from the commodity hedging at around 1.4 billion Thai baht, which basically the loss mainly from the mark-to-market from the higher the good price. And the second factor for the loss of the 2.8 will come from the unrealized then FX loss around 1.2 billion Thai baht, which basically from the mark-to-market from the unrealized from the FX of our dollar position in the bond and also for the long-term debt. And it's been not to be highlighted in Q3. Thai Oil, we already applied for the revenue hedge accounting and under the TFIS number 9. For the concept of the revenue hedge accounting is that we going to the matching the FX gain or loss on the designated revenue or cash flow in order to offset with the FX gain or loss on the US dollar debt. This implementation of the revenue hedge accounting in Q3 helped reduce the volatility of the impact of the mark-to-market and the FX gain loss in the P&L. So that's why in Q3, even the Thai baht depreciated quite a lot comparing Q on Q. So we also get the unrealized gain only 1 billion Thai baht, as we mentioned. I mean, if we compare to the dollar debt, I mean, if we not apply with the revenue hedge accounting in Q3, we will get more unrealized FX loss more than this. And the contribution in Q3 and also the 9 months almost similar, mostly from the contribution. If we exclude the stock gain, the contribution will come from the petchem and the lube, almost 70%, and the rest will come from the power around 22 to 23%, and the around 9 to 10% from the other business, which are basically from the solvent and from the ethanol BU. I think in the later part will be more detail of the performance analysis will be presented by Khun Chorsan.
Hello, good morning. For performance analysis, let me start with refinery. For the third quarter, refinery utilization rate dropped to 92% from 98% in the second quarter, mainly from the COVID lockdown in the early Q3. And the utilization rate is consistent with the industry average. For domestic oil demand in Q3, domestic oil demand dropped by 18.6% year-on-year, especially more gas and gas oil. As a result, our domestic sales volume dropped to 75% of the total sales on the lower right-hand table in Q3 versus the normal level that we usually sell domestically at 85%. In response, we quickly shift our sales to capture export market to maximize our refinery run rate. Let's go to the next page. Despite the COVID situation in Thailand, the situation in other countries improved significantly with lockdown easing in US and Europe, leading to higher oil demand. As a result, oil prices continue to rise, in Q3 to $73 per barrel and move up to $80 per barrel in October with additional tailwind from the energy crisis, while all the crack spread improved in Q3 and also Q4 year to date. As a result, Thai Oil reported accounting GRM in Q3 at $6.7 per barrel, consisting of market GRM of 1.6 and stock gain of $5, while the 9-month GRM, accounting GRM was reported at $6.3 per barrel, significantly improved from last year. On the next page, aromatics. Softening benzene margin from power rationing in China, lower aromatics contribution in Q3. Despite lower P2F at $90 per ton, we still maintain a high utilization rate at 88%. As for LAB, the spread continued to outperform due to limited supply from LAB plant shutdown in China. Therefore, we continue to maximize our LAB plant utilization rate at 180%. In summary, the GIM contribution from aromatic and LAB was at $2.1 per barrel, slightly lower than in Q2. As for base oil on the next page, base oil spread softened in Q3, but still compared to historical average, still at a very high level around almost $900 per ton. This is the softening of the base oil margin was due to higher supply from increasing refinery run in the region, while bitumen spread softened from lower demand during rainy season. With the lower P2F of $187 per ton in Q3 and softer demand, base oil utilization rate in Q3 dropped to 88%. In summary, GIM contribution from lube in Q3 lower to $1.8 per barrel as compared to Q2. But if you compare to 2020, you can see that it's significantly improved. In summary, on the next page, in terms of the integrated margin, Thai Oil reported accounting GIM in Q3 at $10.5 per barrel, higher than Q2. This is come from the market GIM of $5.5 plus the stock gain of $5. For the 9-month accounting GIM, we reported at $10.2 per barrel. This is much improved from last year when we have the accounting GIM at $0.1 per barrel, mainly pressured by the stock loss. As for costs, we can see that the group cash cost on the right-hand side, we maintain our competitive cash cost level. Group cash cost in Q3 was at $3.1 per barrel, slightly higher than Q2, but the 9-month average is still at $2.8 per barrel, lower than 2020 level at $3. This is part of the main business, the core business. On the next part, we'll go to the other business unit of Thai Oil, starting with the power sector. Power contribution in Q3 declined slightly from 700 million baht in Q2 to 650 million baht in Q3 due to lower contribution from GPSC. The lower contribution was caused by a couple of unplanned incidents at the GPSC power plants and also higher fuel costs from the energy crisis. On the next page, for the olefin business, Thai Oil completed a 15% share purchase in Chandra Asri, or CAP, in September this year. The investment was done through a company called Top Investment Indonesia, or TII. As you can see, the contribution from CAP in Q3 was lower than expected due to higher naphtha prices as a result of the energy crisis and also softening polypropylene and polyethylene spreads from additional supply of the new plant in China and slightly softer demand in Southeast Asia. As a result, in Q3, TII reported a net loss of around 700,000 $1,000. On the next page, as for other businesses on the lower right box, the solvent contribution was slightly lower due to softer demand in Southeast Asia. As for the ethanol business, we recorded a one-time profit of 624 million baht before tax from the partial sale of our holding in Ubon Bioethanol, which we sold our shares at its IPO back in September, and we have reclassified the remaining shares. Therefore, we was able to book the one-time profit as mentioned. On the next page, from the core business, refinery and petchem together with other businesses, Thai Oil Group report the consolidated net profit of 2,000 billion baht, slightly softer than the second quarter. If you look at the EBITDA, we reported at 6.7 billion baht, also slightly softer than Q2 as well. EBITDA was lower mainly from the realized loss from commodity price hedging. However, we have the benefit of the stock gain to counter the realized loss from the commodity hedging. As for the net profit, the reason of the lower net profit despite higher GIMs from the unrealized mark-to-market loss on the commodity price hedging and also mark-to-market FX loss on the US liabilities, as Khun Manida mentioned previously. If you compare the year-on-year 9 months, EBITDA and net profit increased significantly to 22 billion and 7.5 billion respectively from improved GIM and stock gain. On the next page for the cash flow, 9 months cash flow is positive at 4 billion baht, mainly from higher net profit contribution. Cash flow from investing is negative at 35 billion Thai baht, mainly from the investment in CFP and investment in CAP. For cash flow from financing, we have a higher cash flow from financing around 1.4 billion Thai baht. This is mainly from the bridging loan drawdown, which was higher than other financing outflow, including the bond and loan repayment, interest, and dividend payment. As a result, for 9 months, Thai Oil has a net cash outflow of 29 billion Thai baht. Together with the beginning cash at 53 billion Thai baht, we have ending cash at the end of Q3 at 24.7 billion Thai baht. In terms of the balance sheet on the next page, yes, the total asset increase from end of last year to 9 months, 30th September this year. The latest is at 345 billion Thai baht from 306 billion Thai baht, mainly from higher non-current assets, our investment in CFP and CAP. In terms of the liabilities, we have higher liabilities, mainly from the interest-bearing debt from the bridging loan. In terms of equity, the equity portion was slightly lower due to the dividend payment. As for the financial ratio, we have the net debt to EBITDA higher from last year at 5.9 as a result of higher net debt from the bridging loan drawdown, while net debt to equity also increased to 1.3 from the same reason. We expect the net debt to equity to drop below 1 next year after we completed the recapitalization and repay the bridging loan. You can see on the right-hand side that our net debt is around $4.4 million, and all the credit rating agency maintains the investment grade for Thai Oil in the 3rd quarter. So that's a summary of the performance analysis. On the next part will be on the market outlook by Khun Nattapol.
Thank you, Khun Tosan. And the next part is the industry outlook for 2022. So I'll cover crude oil price outlook and margin for refinery, petchem, and base oil. Let me kickstart with the crude oil. For crude oil price for the remaining of this year until 2022, we believe that it should be quite supported because of the demand recovery. You can see that especially during Q3 to Q1 next year, we'll have additional demand during winter from like the gas to oil switching. As Khun Ranida mentioned earlier, that during the past few months, gas price spiked to a very high level, even higher than oil. So many agencies forecasted that the switching could be ranging between 500,000 barrels per day up to 2 million barrels per day, depending on the winter this year. If we look further into 2022, demand growth will be about 3.5 million barrels per day. So if we combine growth this year and next year, it almost matched with the decline in 2020 that caused by the COVID-19. So basically, the total oil demand is about almost 101 million barrels per day, very similar level to 2019. In terms of the supply, as you all know that OPEC Plus member agreed to increase the production by about 400,000 barrels a day from August onwards. So until the end of the year, we should have additional supply about 2 million barrels per day. But that is quite insufficient to serve the demand recovery. You can see on the bottom right chart that the supply demand balance is still quite deficit in Q3, Q4, and up to Q1 next year. That's why we are seeing a very high price. And recently, the consuming countries were quite unhappy about the high oil price, so they agreed to release some strategic reserve, about 80 million barrels over the next few quarters. But we believe that that release is quite small compared to the deficit that we are seeing right now. And also the OPEC Plus member could like potentially delay the increase if the SPI is released. So the recent drop in oil price over like $6 to $8 per barrel over the past few weeks could be overdone. So we believe that like $80 per barrel or slightly lower could be more equilibrium level for both consumer and the producing country. And going into the margin side, you can see that the Singapore cracking margin performed very well during early Q4 this year. So average about $7 per barrel. But recently, because of the resurging COVID cases in European countries, so there's some concern about the lockdown policy affecting demand in the West. So the margin and spread weakened a bit. But beyond that, into 2022, we believe that the lockdown could be quite short-lived if situation improve, similar to what happened in Asia during Q3, then the margin could normalize back to like a better level. So if we look at the factors for 2022, we believe that all key products like gasoline and middle distillate will continue to perform to recover better versus 2021. Let me show you some figures for each product a little bit. So let me start with gasoline. You can see that the gasoline demand is actually hitting the pre-COVID level during the summer this year, and for next year it will continue to be improving compared to 2021. in Asia as well, you can see that despite the recent wave in Southeast Asia in Q3, the recovery was quite quick. So we actually approaching 2019 level at the moment, and next year we'll also see some growth. In terms of the pressure in the region, in the past we were quite concerned about the Chinese export, but after they implemented stringent control for emissions and for privately owned refineries, they actually increased some tax for component import and also limit some export quotas for refined products. So you can see that gasoline export for the second half this year became much lower than the past 5 years. And also next year, we think that this situation will continue. So that provides the support in the regional market. And for the middle distillate side, the jet demand is also improving. If you look at the bottom right chart, it's actually quite flattish during the first half of this year because of the restricted traveling in many countries. But after we received some vaccination across many regions, so we are seeing easing restrictions and also improving domestic and international flights in some countries. So in Q3 towards the end of the year, there will be some growth compared to the first half this year. And this recovery part will continue towards the end of the 2022. And this will also provide support to refining margin in 2022. Let me move on to the gas oil and fuel oil in the next slide. The gas oil demand similar to gasoline, we saw that it actually hit the pre-COVID level during Q4 this year. And during this winter, if the gas to oil switching is quite significant, then we can potentially see a very strong gas oil demand during the winter. And coming into 2022, we expect some growth about 700,000 barrels per day for gas oil. And similar to the gasoline factors that I mentioned earlier, the Chinese export for gas oil became much lower as well during the second half this year, and it will continue in 2022. For fuel oil side, the demand was quite resilient during the COVID situation in 2020 to 2021. So the impact was quite smaller compared to other products. So that's why we saw very strong fuel oil cracks during the first half of this year. But after refinery runs improve during like Q4 and towards 2022, we think there will be more supply for fuel oil because the lighter and the middle products are performing better. So we'll see more supply for fuel oil coming into the market. That's why we are seeing the slightly weaker fuel oil spread compared to 2021 on average. And in total, we believe that the gross refining margin will perform in 2022 because of the demand recovery. But during this period, like November to December, there could be some headwinds during the lockdown in the European countries. And then let me move on to the petchem market and start with the aromatics. As you all know that the PX and benzene market has been under like the down cycle because of the heavy capacity addition during 2019 and 2020. So the combined capacity addition for PX was around 14 million tons, but demand growth was about like 2 million in 19 and negative because of the COVID in 20. Right, coming to 21 and 22, we are seeing demand recovery but because of the capacity overhang and also the new addition that coming online during the later this year and also 2022, we still see that the margin for this sector will continue to be under pressure because of the heavy supply. And next slide on olefin side. Next year, we see the capacity addition for like PE and PP about for PE about 3.7 million ton and PP about 6 million ton in Asia Pacific and Middle East. And demand growth is expected to be a bit slower than supply addition. So similar to the aromatics side, the margin for olefin could be lower than the first half of this year that we saw. But during like Q3, Q4, the margin weakened a bit. So we think that this level could be quite sustained into 2022. And the next one is the base oil side. During Q2 this year, the margin for base oil hit the record high above $1,000 per ton above fuel oil, and it weakened slightly in Q3 and Q4 so far because of the higher refinery runs. During the first half, the supply for base oil was quite tight because of the lower feedstock supply from refinery. But coming into 2022, because of the better refining margins, we'll see more refinery runs and the feedstock supply to base oil and also petchem that I mentioned earlier. So the contribution from this sector could normalize because this year actually it went to $2.4 per barrel in Q2 and over like $1 per barrel for Q3 and Q4. But normally this sector contribute about like 60-70 cents per barrel. So we believe that it could normalize in 2022, but still better than average. So in conclusion, we think that the recovery in the margin side and the refinery margin side will outperform, will like outweigh the weakness in the petchem that and the base oil market that we are seeing right now. So the GIM or gross integrated margin is expected to be better compared to this year and should be back to about like 2019 level or like almost the pre-COVID level. And that concludes the presentation from the company.
The section has come to an end. So on behalf of the Stock Exchange of Thailand, I would like to thank you investor and corporate for joining the conference. We look forward to welcome you all again in the next quarter. Thank you very much and have a good day. ขอบคุณค่ะ